I'm Deborah, the founder of Elevation Wealth Partners, and this is our first market update of 2024. It's my pleasure today to have a conversation with Dan Fearnow of MFS Investments. Dan's been working with that firm for over 25 years now, so he's seen it all before pretty much. He lives up in Colorado with his family. Hey, Dan, thanks for coming and joining us again.
Good morning, Deborah. Happy New Year.
So can you even believe that another year has gone by? It seems only 5 minutes since we were having this conversation a year ago. And we started the year out last year with high inflation and a lot of worry, and markets, of course, in 22 had dropped. And so no one was happy to start out the year. So why don't you start out by giving us a short recap of the year last year?
Yeah, great to be here. Last year was a recovery year, I guess is what we call it, right? We had probably the most anticipated recession that never happened, right? And I think we had all this volatility that came with it. I think we had sell-offs in March, in May, in October. You remember having those conversations, Deb, and all the volatility out there. But if you didn't sell out and let your emotions take over, the S&P was up, I think 24%. The NASDAQ was up 42%. Dow was up, I think in the 14% range. So we had a pretty good recovery year. And I think it really gets back to that recession that didn't happen. And there's a couple of reasons we think that the recession hasn't happened. If it does happen, it's probably going to be on the milder side this year if we do have a recession. I think it's really the fact that the economy and the consumer are less interest rate sensitive than they've been in the past. And I'll give you a couple examples. If you just think about our economy going back to the 1970s, we were more of a manufacturing economy. We built things, right? And to that end, you took on debt to add equipment, to upgrade machinery. We call it capital expenditures. And that's interest rate sensitive, again, because you're taking on debt. If you flash forward to where we are today, we're more of a service economy, less interest rate sensitive. And then you think about the consumer. And, certainly a lot of statistics out there as far as record amount of household debt that gets a lot of headlines, right? But at the end of the day, it's not just what you owe, it's what you produce, what you make. If you look at household debt as a percentage of the GDP, gross domestic product, what we make, if you will, those ratios have been coming down since the global financial crisis. And the fact that the consumer, the interest rate payments as a percentage of the consumer's income, it actually is falling as well. So less interest rate sensitive from an economic standpoint, from a consumer standpoint. Incredible recovery year for sure. A lot of talk about the Magnificent Seven, right? The technology, the AI. We're going to talk a little bit more about that, I think, as we get into this. But we had a concentrated performance of a few technology stocks. And if you look at history, concentration doesn't last forever. So we certainly see opportunities as we get into this new market, this new year, and look forward to the opportunities that present themselves.
All right, so that's what was happening, but of course we all want to know what's going to be happening in this year. So let's talk more about interest rates, because I feel like that was one of the really key things of 2023 is what was going on with interest rates.
Yeah, I mean, if you think back to 2022, really, this all began with the Fed that had rates at really zero and went on this incredible hiking cycle, 0 to over 5%, hiked, I think, 11 times. And if you think about history, that was a 1 in 285 year event, Deb. 1 in 285 year. So you're saying there's a chance and it happened. I think the probability is about 0.35% with what happened in the treasury market when the Fed's raising rates. Obviously, treasury prices going down at a double-digit decline in 2022. So that was the carnage that was 2022. And and really going into 2023 to try to fight the inflation. It wasn't transitory; it was sticky, and the Fed had to act. And so we are on the back end of that cycle. We think there's no guarantees, but I think going into 2024, the Fed's probably close to being done, if not done, and we could see potential cuts into 2024, latter part of the year, which obviously would help the consumer and be opportunities on the borrowing side.
Yeah, and people are definitely looking to have those mortgage rates come down anytime the Fed would like to help make that happen. And so what else do we expect is going to be an influence in this year?
Well, I think everybody's favorite topic, and trying to be humorous, but politics.
The
Certainly,
election, yes.
it's shaping to be an interesting one for sure, and a lot of focus gets put on that from the investment standpoint, from maybe investors that don't have a financial relationship with an advisor, and they see the press, and they make rash decisions based on who's potentially going to be in the White House. And I think if you look at history, we have a pretty big data set going back, certainly at least to the 1970s and the Carter administration. And if you just look at when the president gets elected, what their agenda is for the State of the Union and what they're trying to accomplish during their administration, the success rate going back to the 1970s through the last administration here, success rate is about 20%. It's a pretty low success rate about what they're trying to get accomplished. So don't focus so much on who's in the White House, but certainly look at where we are from an economic standpoint, from the strength of the markets, the economy, the consumer, certainly earnings and valuations that will drive stock prices, not who's in the White House. Don't focus so much on that.
Well, thanks, Dan. And that's important for us to keep in mind, because we're going to be bombarded by things in the media saying that because of this or that in politics, it's going to make your investments, your money disappear, perhaps. So amongst all of this, we know that your firm still does its work to help our clients make money with their investments. So what are the areas of potential growth and the investment opportunities that MFS is seeing?
Yeah, certainly not here to give specific recommendations. That's what you do for a living, Deb, but certainly opportunities at the end of the day. I mean, we've been investing for 100 years this year and really focused our efforts on high quality investing. And I think that never goes out of favor. You look over long periods of time, high quality does outperform low quality companies. And certainly if we're in the latter part of an economic cycle, maybe recessions potentially out there this year, you want to look at and certainly lean in on larger cap, higher quality companies that have free cash flow, that have durable franchises, durable practices, businesses, strong balance sheets that can offset any type of maybe economic headwinds, if you will. So still focused on quality at the end of the day. Certainly on the equity side, bond side present a tremendous amount of opportunities as well, with the Fed potentially cutting rates. We had a pretty big rally in bonds, probably one of the best Novembers. We had best months we've had since the 1980s, I think, in the fixed income side. So we certainly look at opportunities in a market like municipals, tax-free investing, huge outflow cycle. We had $144 billion in outflows, redemptions in municipal bonds over the last 2 years. And so demand's been extremely weak, but that is starting to turn the corner. And if we can get an uptick in demand, I think the offset there is the supply of bonds out there is pretty constrained. So, increasing demand, maybe constrained supply side, what we call a strong technical backdrop makes sense from an investing in munis. And then the fundamentals, the strength of the states is pretty darn strong right now. So we certainly see opportunities in bonds, specifically high quality municipal bonds.
And then what else? I know that not everything is happening in the US. So can you talk a little bit about the international scene?
Yeah, international, certainly there are a tremendous amount of opportunities. Some of the best performing companies are outside the US. We've had pretty much a decade of a strong dollar, which has been a pretty big headwind for ex-US investing. But if the Fed is potentially going to cut this year, you could potentially see a weaker dollar, which would be a nice tailwind for ex-US international investing. Valuations certainly are cheaper on a historic basis than the domestic market. And I just think from a simple diversification standpoint, Deb, you have the S&P, the domestic market, which is pretty concentrated in tech and healthcare. 50% of the S&P is technology and healthcare. You look outside the US, you have opportunities. 50% of the EFA, the international benchmark, is financial services and consumer capital goods. So, just an opportunity to get more diversification in some of these sectors outside the US and not just focus on that domestic market.
Yeah. So then I have two more things to ask you about, Dan. It's what everyone is excited about. The first one is, what about AI?
Artificial intelligence certainly was a big theme last year. We've both been in this business long enough, Deb, to go through these cycles. It was the .com era back in the late 90s. Cloud computing was kind of the buzzwords the last few years, and now it's artificial intelligence. And certainly the Magnificent Seven and a lot of the stocks and companies have been benefiting from this hope of AI. But I think you have to certainly look at it as early in the stage. There's going to be still a lot of outcomes, whether this is going to be some type of a generational transformational type of technology or not. There's going to be winners and losers. So I think as a company that's been around for 100 years, we'd rather focus on certainly the infrastructure of artificial intelligence right now, where we see opportunities.
Yeah. So what is that infrastructure, by the way?
Well, I think it's the guts. I mean, if you think about trying to make computers and computing smarter, I think you have to have power. And I think that's an industry like semiconductors. Chips certainly is an area, and the software to back up all that new power and that new knowledge from the computing standpoint. So those would be areas of opportunities for sure.
Yeah. Thanks, Dan. So I said there were two things. Number two, we just had breaking news last week that you can now buy Bitcoin as an ETF with some firms. So is MFS ready to jump on that bandwagon right now?
I think it's tough for an investor that's been around for 100 years to look at something like Bitcoin that really has no backing, no earnings. It's really more speculation, I think, is more what that is all about, what the next person's willing to pay for that Bitcoin. And it's really tough to value something that has no value, if you will. So we stick to investing, not speculating. We'll let other people speculate. And you can certainly there's a tremendous amount of upside, but at the same time, there's tremendous opportunity for downside. But certainly looking at the blockchain infrastructure, I think that's where there's some opportunities there. Those are the type of areas, again, from an infrastructure standpoint, where we see opportunities.
Well, we will wait and see as to what develops with those areas. I think we talked in the same way about tech companies in the 90s, right? It was all brand new and nobody knew what would happen. So we have an evolution, new things on the scene here. So it's time to wrap up, Dan. So what are your last thoughts you'd like to just say?
Yeah, thank you for the opportunity to be here, Deb, as always. I wish you the best in the new year, and certainly there's going to be volatility out there. I think at the end of the day, you still need to focus on the game plan. For us, it's about being diversified, being active, been an active manager for over 100 years and believe in the power of financial advice. And at the end of the day, whether it's going to be a political cycle, maybe short-term volatility through that election cycle, see through the trees, believe in the plan that certainly Deb's put together for each one of you. Believe in the power of advice, stick to diversification. It never, ever goes out of favor.
All right. Well, thanks so much, Dan. And that's it for today. We're going to be posting this shortly, and our next market update will be in March. Thank you for listening.